All right. Good evening, everyone. How are we? Apologies for the lateness of starting this stream. I'm going to have a guest join me fairly shortly for this as well. I'm also simultaneously streaming on Instagram as well. So let's talk a little bit about mortgage rates because inflation fell. Or at least we got the announcement that inflation fell uh, last month reported in the arrears. However, we're still seeing that food prices are pretty high. They're still at an all-time high, actually, which means that we're in it for the long run, really, to be honest. And the question I want to ask here, or try to ask and answer here, is at what point are we going to see interest rates fall and therefore mortgage rates fall? So I was actually speaking at an event with Barrett Holmes on Tuesday this week, so a couple of days ago, and we would. This is a topic of conversation. This and now affordability, because what tends to happen is that when interest rates go up, or the banks feel as though mortgage rates need to go up because of interest rates, clearly, what they tend to do is they then tend to often tighten their affordability test that they do for applicants. And what that basically means is that they'll take into consideration things like your childcare cost, any outstanding debts, personal loans, car finance, credit cards, those kind of things. They'll take all of that into consideration. And if you could borrow 4 or 5 times your salary to begin with, what they will lend you will be reduced by a calculation that is put in the background around the things that you have to commit to. And so for first time buyers, certainly there's almost a double whammy effect. Not only are you having to contend with higher interest rates, so therefore your mortgage payment is going to be a lot higher, but you're also then having to contend with the fact that now affordability is a little bit tighter as well. And so what we're looking to do here is try and ask the question. There's a lot of data that's been coming out over the last week or so, certainly that I've been seeing around inflation expected to fall very, very sharply over the rest of the year. I'm going to go through some of the forecasts. In January, we did this in the channel just to set the scene around the inflation forecast and hopefully try and get to the bottom of what's going on with mortgage rates. And I am going to be joined by Sam Norris to actually talk this through with us as well. Um, Let me just make sure that Sam has actually got the right link to come into Restream, and then we can get into some of the detail. I know Sam, you're already on YouTube, so if you want to, sorry, on Instagram. So if you want to request me on Instagram to join here, and then I'll figure out what you need to do for YouTube as well. So the link that I sent you should be a Restream link. So you just need to click that link to come straight in. But anyway, let's have a look at some of the headlines whilst Sam is figuring that out. There we go. He's going to join on Instagram right now. There we go, and we'll get him onto YouTube in just a moment. See how we get on with this. Hopefully this will work. I've never done this simultaneously where we're doing Instagram and YouTube at the same time.
There he is.
There he is. All right, okay, so
I did click your link.
okay, so it should bring you back into the back office. So bear me 1 second. Let me just try and I'm going to resend you this, mate.
Says waiting on host at the moment. That's all.
Okay, right. 1 second, mate. Let me just email you then. Let me just email you the link to use now. How have you been anyway?
Well, I spent the day in Brum today in sunny Birmingham.
Nice.
Yeah, believe it or not, I was at an event this morning all about how to grow your business on TikTok. And the age range in the room was probably, I would say, averaging late 30s, early 40s.
Really?
Yeah.
I was going to say, did you feel out of place because it was going to be all from generally younger people? Right at home.
My age demographic, my brain demographic, I was thinking this person there, but
Brilliant. Okay, cool. Right, let's get you in. I've just sent you the link now. So on your email, that should bring you into the backstage on Restream for YouTube.
Yeah,
and by the way, guys, if you are watching on YouTube, by the way, make sure that you you can use the chat section to leave any questions that you have. I'll introduce Sam in a moment once he's in here, because he's actually practicing in the property market and the mortgage side to things. So he'll be able to answer your questions with more of a, I guess, immediate ear to the ground of what's happening currently from a lender's point of view. So make sure you're using the chat section for that as well.
Yeah, just waiting on getting that link through, mate. So whenever I get it, I'll get it.
Let me text it to you as well, just so we can double work on this as well. One sec, this might go dead just for a second whilst I multitask this, mate. Paste. There we go. Just sent it to you on text as well. Just sent you on text as well, mate. So you should have that, hopefully.
Awesome. Right, what I'm gonna have to do is we come out of this.
Yep.
Get the link.
Yeah, sure.
It's on my laptop.
Go for it, mate. See you in a sec. Cheers. All right. So in the meantime, just on YouTube, let me just share my screen with you, just to kind of highlight and just give a reminder of where we are in terms of some of the numbers that we're working with. And again, if you're on Instagram watching this, might be worthwhile just jumping over to YouTube. You'll be able to, it'll be a better aesthetic, so you can actually see some of the screens that I'm going to be sharing, because I can't do that on Instagram. So this is the forecast at the moment for the UK. Okay, so when we look at the number that we're interested in here is inflation. So inflation right now is at 10.1%. Now, we've not had inflation at the lower end for what feels like a very, very long time now. We've been in double digits for quite some time now. So the inflation number at the moment, 10.1%. Now, the forecast for inflation, which is going to be indicative to and will tell us whether or not it is likely that the bank rate will start to come down, and therefore possibly interest rates will come down, is this inflation rate. So the target for quarter two of this year is 7.4%. That's the target, okay? Q3, they're looking at 5.8. Q4, they're looking at 2.9. At the beginning of 2024, they're then going to be looking at 2.7%. Sam is here right now. Okay, so I'll bring Sam in a moment. So 2.7% at the beginning of 2024. Okay, that's the goal. That is the target. However, there's a lot that needs to go right in order for that target to actually come to fruition. Now, in a lot of the articles, what they are stipulating is we're going to see another rate rise in May, so next month, and from that point onwards, what they're predicting is we'll see a sharp reduction in inflation, because inflation will start to fall away. And there are a number of factors that they're given as the reason as to why that may be. On Instagram, I posted this last week that one of the factors that they were quoting, which is quite interesting, was the fact that we have an aging population, and the curve of spend means that as we get older, as you're older, you tend to spend less money, which means there's less money in the economy. Therefore, prices might actually fall a little bit more. But actually, let's bring in Sam.
Hello.
There he is. How you doing?
I'm good, mate. How are you doing? All right?
Yeah. Let me just make sure I got my audio right here as well, just to make sure everything's coming out the right places. This is what happens when you try to multitask out of and it was me being disorganized as well, more than anything else.
No,
I should have been a little bit more organized. There we go. You're coming up the right source now. There we are.
Excellent. That's what we like to hear. I've got a face for TV, so it's all about what comes out.
Oh, mate. No, but good to have you here, and good to see you as well, mate. I know that you put a really interesting post out earlier around the buy-to-let market, and the article being the fact that actually it's not meant for consumers, it's meant for brokers like yourself that work in the space in the lending side.
Maybe a bit too controversial. Maybe if the bloke that I pick up who wrote the article, if he sees it, he's probably going, "Who's this idiot?"
Yeah. So, are you able to join on Instagram still, Sam? Are you able to do that still?
The only thing I'm thinking is if I do that, you're gonna, because I'm gonna hear you. We're gonna hear.
Oh, you're gonna hear twice. Okay, cool. That's fine. That's fine. All right.
I only thought I had.
So let me just say, guys on Instagram, Sam can't join once on YouTube because obviously we're gonna have split audios and stuff. So I encourage you, come over to YouTube and you'll be able to ask questions here, basically. So do an introduction to yourself first, Sam, so that people kind of know who you are.
Yeah.
Briefly. Cheers, mate.
Cool. Yeah, thanks for inviting me on, by the way, Peter. So my name's Sam Norris. I run a mortgage brokerage or property finance brokerage called Grand Union Finance. We specialize in working particularly with property investors and developers to help them raise finance. So we're not your typical, sitting at the back of an estate agent type mortgage brokers. As you can see, no suits, no ties, no problems. And I've been in the industry now for, believe it or not, 16 years. I know I don't look old enough to be in any industry for 16 years. But in that time, I've helped countless investors and developers raise finance, help them grow their portfolios, their property development companies, etc. So I like to keep a finger on the pulse of what's going on. And I like to tell the world about it as well. And I don't shy away from my opinion on things. So hopefully, Peter, I'll try and remain as uncontroversial as possible.
No, listen, mate, knock yourself out. Be as controversial as possible. I got no qualms whatsoever with that. So what are you finding at the moment, property-wise, mortgage-wise, interest rate? What's your take on it all?
Yeah, do you know what? Standard buy-to-let stuff's tough, man. It's really tough. And this is what you alluded to in that article that I picked up on Instagram earlier on, which is that it was quite a misleading article. It was saying, that the buy-to-let mortgage market is in a good place. Yeah, if you're a broker, it's fantastic because you've got a load of people that really need our help more than they ever have done it was certainly in my memory of this industry, even more so than the credit crunch, in my humble opinion, because the rates are a lot higher. They've gone up quickly. We're not in a traditionally historically high interest rate sort of level. But because
not compared to the 1970s, no.
Exactly. But it's the comparative speed in which, the velocity in which those rates have gone up that have caused the problem that we have. And ultimately, as I think we've said before, everyone talks about supply and demand as being an issue or as being the driving factor of the property market. Well, yes, but what drives the demand? The availability of money. And from a buy-to-let perspective and from a residential perspective, we are seeing, from a residential point of view, affordability is as tight as it's been in a long time because we've seen exponential growth in the property market, in the average price of a property in the last decade or so since the credit crunch. And now we've got rates as high as they've been in that time frame as well. And the two aren't quite marrying up, which means it's as difficult as it has been in probably the last 20 years to actually afford a mortgage to get the average priced home with the average priced income. So that in itself is reducing the demand. And of course, we also know when it comes to buy-to-let rates, because lenders need to add a stress test level onto their standard rental calculators, we're also seeing buy-to-let investors that need to refinance or buy property struggling to get the loan amounts that they need. That magic 75% is eluding a lot more people than it has done for quite some time. So it's a really tricky market at the moment. Really tricky market.
I spoke at an event this week with Barrett, and I've kind of already alluded to this in the intro to you coming on. Affordability. And that is a huge issue for a lot of people at the moment, especially first-time buyers, because first-time buyers are having to struggle with the fact that they've got to raise a deposit first and foremost. Interest rates have increased, so that means the mortgage is actually going to cost them more to actually service. But now, because of the circumstances, affordability is being tightened. Can you just explain how that actually works for people who are listening? Because I think it's a really important point for people to understand to gauge whether or not they're in the right position to actually go for a mortgage or not.
Yeah, absolutely. So one of the biggest misconceptions I see in the residential side of things is how lenders actually work out how much they will lend you. Because everyone goes, oh, don't they lend you like 6 times your salary? No, that is the way that it used to be. We had something, oh God, I can't remember which year it was. I think it might have been 2016. We had something called the Mortgage Market Review, which ironically, if you know your history, a lot of the regulation that came in was actually from Europe, from European central banks that came in, and we had this, new ways in which we had to figure out how residential mortgages were going to work. Essentially, we had a bit of a change in regulation. We had the PRA that came along, the Prudential Regulatory Authority that started looking after things like buy-to-let mortgages and all that kind of stuff. And the FCA changed very much the way in which affordability works from a residential mortgage perspective. And affordability is the most important term there, because instead of just saying, right, you earn X, therefore times that by 4, 5, 6, whatever it might be, and that's how much we're going to lend you. What lenders then started looking at was, right, okay, let's look at your income. That's great, but we actually are now going to really drill down into your expenditure. And what they then look at is, what surplus on a monthly basis have you got? And if we stress tested our interest rate, would you be able to afford the monthly payment with the surplus you've got, essentially? We have seen a little bit an issue recently where the government have kind of tried to push back on lenders. Really dangerous. But what we've seen recently is that rates have gone up. So the amount you're going to pay on a monthly basis has increased. We haven't really seen incomes go up very much, if at all, but we've seen expenditure go up hugely as well. So out of those three things, one hasn't changed and two have got worse. So of course, the knock-on effect is fewer people can afford the mortgage that they could have afforded this time last year.
Yeah. And I think that's a really nice way to break that down, because this is something that I mentioned on Tuesday when I was giving this talk and saying, especially because you're looking at disposable income. For a lot of people, disposable income has been squeezed because energy prices, food prices, fuel prices have gone up. So you've got less. But also for, people who may be looking at getting on the poverty ladder. So I've got a friend who's been in this exact position, trying to get on the poverty ladder. He had a little bit of debt. He's got 3 kids. So by the time you factor in debt, you factor in 3 kids, childcare costs, all of that kind of stuff, all of a sudden affordability becomes something that actually you've got to prioritize paying down debt, because you're not going to get rid of kids. And I think that that's something that's really, really important for people to understand in terms of the preparedness for actually getting on the property ladder and actually trying to figure out whether you can actually afford a mortgage or not. And you made a great point there as well. Stress testing. The banks do this, but I think it's really important as a consumer, as someone who's going to be going into a mortgage, to actually stress test this stuff as well. Because if anything, interest rates going up as much as they have is a really great example of what happens when, the mortgage that was comfortably affordable for you today automatically doubles or goes up significantly because interest rates have basically moved, and you have no control over those factors either.
Exactly. And that it's something that gripes me quite a lot, because and look, especially a lot of people that are in my industry, I personally, I've got my team. I personally don't do a lot of residential mortgages anymore because I focus very heavily on the investor side, as you know. But what upsets me is how brokers and banks and stuff like that are just so happy just to be going, yeah, you can afford a 95% loan to value mortgage. Here you go, have it. When actually thinking about, should you have it? Just because you can afford it now, what's happening down the line? Imagine right this very second, you get a 95% loan to value mortgage, you find your 5% deposit, you do that, and you stick it on a 2-year fixed rate because that's the cheapest rate that's available right now. Well, what happens in 2 years' time? Are rates going to be that much different in 2 years' time to how they are now? Probably not, no. Is the value of your property going to have gone up significantly in that period of time? Probably not. Could it have gone down? Possibly, yes. At the beginning of your mortgage term, when you're paying capital and interest, because your payment stays the same, but what actually happens is at the beginning you're paying more interest, and when you pay off a tiny little bit of that interest, it means that next month you pay off slightly less interest, slightly more, as in terms of a ratio, slightly more capital. So for that 2-year period, you're probably paying down your balance very little. So in 2 years' time, you could then be in a situation where you're actually at 96% loan to value because the value of your property's gone down slightly. You've then got 2 options. You either need to find that 1% of your property value, which, as we said a few moments ago, not a lot of people have got a load of money just hanging about at the moment, or you're going to be forced to then go on to a lender's standard variable rate, which at the moment is averaging 6, 7, 8%. That's going to cripple the vast majority of people. Now, I don't say all this stuff to upset people or to worry people. It's just the reality of the situation, and it's not being talked about at all. The dangers 100%. Of these high loan to value mortgages. I've said for years, if you can't put down a 10% deposit, then don't buy a bloody house. Rent or live with your parents. Like no one has a divine right to own a property in this country, which unfortunately these are the messages that are being sent out to the public. If you don't own your own home, you're somehow, a lower standard of human being. You're not in the slightest. It's, up until recently, the vast majority of people didn't own a home. Like 8 people in the whole country owned property in like 200 years ago. And it's a relatively new phenomenon. So I think people just need to be really, really cautious and not see this goal of owning a property as like the be all and end all in their life. It really isn't. Getting financially sound, getting understanding good money management should be their number one goal. Everyone's number one goal. Get debt free. Get safe with your money, then think about buying a home. A home is a luxury, not just something that everyone should be aspiring to.
Yeah. Now, one thing that, and again, if you're on Instagram and you're watching this, I know that there's a number of you queuing up here. You're going to get the full benefit of this on YouTube because Sam is really explaining some stuff. So I just want to go back a little bit. What you described in terms of the ratio between interest and what you're paying off on your mortgage, that's something called amortization, which means that on the loan, in the early years, what the banks are looking to do is they're looking to take as much risk off the table as possible and trying to, I guess, benefit as much as possible from your interest rate. So what you're doing is you're paying a large chunk of interest before you start paying into the capital amount that you actually owe on the mortgage. And that is really important. I mentioned this on Tuesday. If you go for a 95% mortgage and God forbid the market tanks, for example, 10%, you could potentially find yourself where you might be in negative equity. And that's the last place you want to be. Now, that's all very well and good if you're in a house that you're going to be in for maybe 10, 15 years. But if it is a stepping stone where your intention is maybe we're going to get this one because it's the stepping stone to get on the property ladder, maybe flip in 2 or 3 years time into something bigger because you're hoping for that equity appreciation, then that might become a little problematic for you. So it's worthwhile knowing these things ahead of time so that you've got your eyes fully open to all of the eventualities that might happen as a result of all of these things that are outside of your control. I mean, in terms of interest rates, because that's where I'm really, really interested at the moment. And again, I honestly, there was an article today saying that we're going to see another interest rate rise in May, and that should be the last one for the year. What do you think?
So we love to basically just jump on the coattails of our Yankee cousins. If you look at the history of the Bank of England base rate versus the base rate over in the US,
tracks
pretty much mirrors it.
In fact, it's like they're on the phone to Jerome Powell. Like, what's going on, buddy? What's going on, buddy?
What you thinking? Yeah, I was thinking 0.5% too. Yeah, I'll tell you what, you go first, right? And then give it a couple of months, we'll do it. Yeah, okay, cool, wicked. Yeah. So they've been up at 4.75%. Now, do I think we're going to go to 4.75% at the next meeting? Do you know what? I really hope we don't. But who's to say we won't? If they're genuinely saying they reckon that this is going to be the last one of the year, then it could be 0.5% because we will go and match the base rate over in the US. Now, I've seen quite a lot of stuff come out in the press suggesting that we're going to max out at 4.5, which obviously would be less of an increase. So
I'm seeing that as well. I mean, if you look at the forecast, this is the forecast right here. So they're saying, Q2 4.25, but Q3 4.5% in Q4. Mm-hmm. Then we drop back down to 4.25 in 2024. So I don't know, mate.
The reality is, I mean, I don't know if you saw my reel the other day about all the hoo-has going on in the news. Inflation's down, by 0.3%? Oh, man. Yeah. Whew, that's exciting, isn't it? Uh-huh. Inflation is... Look, at least it's not going up. At least it's not going up. But the reality of it is the base rate is not going to be coming down until we hit 6% in inflation. So is that realistic over the course of this year? Maybe. But the reality is I reckon we'll be I still think we'll be above 6 by the end of the year, which makes those predictions look pretty realistic to me. Because if we hit, say, 5.5 Q5 to 5.5 Q1 next year, that will then push the base rate down a little bit, I think.
But all right, so here we go, Sam. So and this is the thing, right? I feel as though sometimes when they throw these numbers out in official documents like this, and this will come from the OBR and all this kind of stuff, it comes from Downing Street. I wonder whether they just throw this stuff out there just to be like, let's not paint a really crap picture and just not scare everyone, right? So let me just share this again, right? So this is the target for inflation. I've been looking at this all year thinking, how on earth are you predicting that by Q4 we're going to be at 2.9%?
I tell you what, mate. If it's 2.9 in if it reaches that in Q4, I'll take you out for a Nando's. There you go.
Oh, mate, I just don't see it happening. It's like
It's not
it's
gonna
such a
happen.
huge drop from where we are right now.
I think the
And like I think
5.8 is ridiculous in
I know,
Q3.
right? I
That's
know. But
ridiculous.
where is that reduction going to come from? I mean, a lot of it is being driven by the fact that fuel prices, maybe they've come down a little bit, but food is still extraordinarily expensive in comparison to where we were 24 months, even 12 months ago.
I'm more
So
concerned about the price of a pint at the moment. That's really making me.
I'm going out for a few beers on Saturday. So it's like, yeah, we'll see how I've not been out for a while for a few
My
beers.
bank
So
manager is not happy with me at the moment.
how much is a pint these days anyway?
Do you know what? I was in Brighton on Saturday, and there was a bar in this wherever we were, this place where there's loads of places to eat, and the average price for a pint was £7.25
£7.25
in Brighton.
I'm
Yeah.
sure at some point, because I've not been to a pub for a while, but I'm pretty sure the last time I bought a pint was something like, £3.50, £4, something like that. I mean, I
Yeah.
remember buying a bottle of drink in London by Tower Bridge. A bottle of water was like £8 like
Whoa,
last year, and I was like,
it's worth more than gold. That stuff.
you know what it's like when you pick up a bottle of water, you don't bother looking for it. You're thinking, "Hey, you're on autopilot." I was talking to someone, hand it in. It's like, that will be £8.25, please. And it's like,
Excuse
it's a
me.
bottle of
Do you know,
a bottle of sparkling water.
I saw one of my old ex-colleagues. He posted on LinkedIn today. He said, "I've been hearing all this stuff about inflation. Now I can see it. Price of a can of Lynx Africa was £5." So come on.
Oh dear.
Man.
Yeah. I mean, look, mate. I don't know, mate. I think it's really important for us to kind of let people kind of know, and that's the reason why I do what I do at the minute. And I don't necessarily want to paint a doom and gloom picture, but I think it is really important for us to know, because I don't know about you. There's a lot of people who are if you're a first time buyer, I can understand that you feel a little defeated right now, because it's like, how am I going to make this all work? And then when you get figures like this and the forecasts, and I can't see that happening, mate. I just can't. I mean, I think that what will probably happen is, or at least we have to accept, a new level of inflation above the 2% that it's been for years and years and years and years and years. The question is, will the central banks actually revise what that acceptable level is going to be? Because I think we're at that junction where it's going to have to. I can't see us getting here. I definitely can't see us getting here by Q1 2024. I personally cannot see it.
I think all of those numbers probably just need to be pushed back 2 quarters, and we'll see. I do think we'll see some gradual decline over the rest of this year going into Q4. But yeah, I think it will still. I think, we've seen, was it now 10.1. By the end of this quarter, will we be below 9.5? Sorry, 8.5, sort of that sort of level. Maybe not. Like, do you know what I mean? When you're talking about that, like end of Q2, and they're saying it's going to be, whatever it was there, 5.8. I can't even see
7.4 Q2.
I can't even see it being less than 1% more than that. So yeah, I just cannot see it. One thing we do have to take into account as well, and this is where it's really dangerous, and you know this a lot better than I do, but there is an element of manipulation over what inflation actually is, because the powers that be can determine what is in the list of things, what's in the shopping basket, that constitutes what they actually take into account, and this can change. So this is something that a lot of people just don't even know about. And
It's such a cynical way to look at the world,
I
but
know,
at the same
I
time,
say,
you wouldn't put it past them.
cynical.
But you wouldn't put it past them though. Should we put a pint of milk in there? No, milk's gone up a little too far. Let's replace it with let's have a loaf of bread instead, or some eggs or something like that.
Down by 4p. That's good. Yeah, we'll stick that in there.
Exactly. So, I mean, do you think we'll get to a point where the base rate and inflation numbers will actually match up at 2%? Do you think that is something that we'll see? Because that's going to be a big determining factor for interest rates and mortgage rates.
I'd probably say not in the next 18 months, at least. I think the thing is that let's taking it back to talking about the property market, which obviously and related to the mortgage market.
Yeah.
When do we genuinely think that when's the next property price rise is going to start? And the reality of that is, I think, we're waiting about 18 months potentially. Opportunity. Property prices are not on the rise. So if you're an investor, I don't think we're too far away from the market maybe bottoming out, and it'll be a good time to start buying potentially. So if you look at it from that point of view, when are properties going to start rising again? Let's say potentially 18 months. Well, what's going to be one of the contributing factors to that? The availability of cash. Well, that's probably because then mortgage rates might be coming down a little bit. It might be actually, to be honest, that we just get very used to, and this sort of moves it on an extra level of technicality. We might start getting used to longer term fixed rates, because at the moment the longer term swap rate money is cheaper. So I was talking about this earlier on to somebody about how there is actually there are less 2-year fixed rate products on the market right now than for a long time, and that's because it doesn't make commercial sense for a lot of lenders to lend 2-year money. So when the SONIA rates are swap rates, for those that are watching, that's kind of the interbanking loan rates that can change on a daily basis. It's a lot cheaper to borrow money more long term. So I think maybe we'll start seeing more 5-year, 7-year, 10-year fixed rates, because that's going to be where the cheaper money is. That's where it's going to become more commercially viable for lenders to lend the money. And when we start getting our head around that, maybe that's when it will become much more affordable to get a mortgage, because we'll see those rates drop. And then that's when we'll start seeing that little dip in mortgage rates. It will just dip into the level where affordability changes to the point where suddenly the demand then grows. So maybe that will be when that happens. But I mean, look, we really are just sticking our finger in the air really here, aren't we? It's so difficult to determine. I've never known a market like it where it's so hard to predict what's going to happen.
I was reading something a little bit earlier on. I think they were saying that the average 2-year fixed rate mortgage is about 5.49, something like that. There are 5-year ones on for about 4.7 roughly. And it's so weird, because last year I did a poll on Instagram where I actually asked people, would you go for a longer term fixed mortgage, so 10, 15 years? At the time, the answer was no. Why would we? But ironically, and you talk about the states have done this for a very long time. They fix into mega long, like fixed rate mortgages, 20, 25 years. It's just in the UK. Yeah, we're the only ones.
We are the only ones. It's really normal in the UK to refinance every 2 to 5 years. That's really, really normal. You go to Spain, Portugal, France, Italy, you just get a 30-year mortgage and it's all on the same rate. That's normal. The concept of refinancing is a British concept. It doesn't happen in other countries all that often. So we may be forced into going down that sort of a similar sort of path. Is it good? Is it bad? Us brokers get less business because we have less refinances to do. But then again, I'm pretty lucky in the fact that I've decided to be in the investor market, where my clients will do regular business with one another because they're buying properties, etc. So, but yeah, in terms of the actual, from a banking perspective, the vast majority of mortgages are residential, and if they're going to be fewer and further between, they're less transactions. Will that have a knock-on effect?
Well, actually,
That's quite
whilst you're on this, let me also be a little cynical. So basically, what Sam has basically said, for the benefit of people on Instagram who might be watching this right now, who aren't already here on YouTube, that basically Sam has said, in the United States and other, Europe, they fix him for way, way longer, 30-year fixed rate mortgages. What that basically means is that, from a refinancing point of view, you don't do it. Now, let me just be a little cynical, right? Because you've already alluded to the fact there that it means that mortgage brokers don't make more money. The banks don't make more money, but actually not refinancing for 20, 30 odd years basically means that amortization piece that we spoke. So imagine you buy your first property, you trade that in 5 years, you're probably just at that point where you're paying less interest eating into your capital properly at that point, right? But now you go and sell that property, go and get a new one. It's a bigger mortgage. Guess who's making more money? Because of the amortization rule, the bank is actually making more money. And so it kind of makes sense when people talk about, and we're not in the environment where this is 100% possible at the moment, to say, try and buy the house that you're going to stay in. If all things being equal, affordability wasn't an issue, house prices weren't as high as they are, that's what most people would do. But there's a benefit in doing that. And from a cynical point of view, banks won't be able to benefit from the amortization. You won't have the legal fees, the broker fees, all of these product fees that typically go with mortgages and stuff. So it's an interesting angle to explore, really, when you talk about how mortgages work and how people should really be thinking about them.
Yeah, completely. It's like you say, there is a cynical element to it. Do you think is there a driving force behind this in some way, shape, or form? I mean, like you say, it's the number of transactions that banks can do. And the thing is, I mean, if you really wanted to pump this out as a much bigger idea, if banks are doing less mortgage transactions, they need less employees to do it. Already we're seeing a lot of stuff go online with the banks. Does AI come in and start, doing even more with a lot of the decision in principles and all this kind of stuff? You're losing jobs in the industry as well. It's definitely something to think about. I quite like the market that we have in terms of the regular 2 to 5 year kind of turnarounds, because I think it forces people to reassess their finances. And as much as, you do lose out a lot of the time on the residential side, don't forget, Peter, as well, there'll be, they might not charge anywhere near as high a fee as they would do. Often the lenders will offer free legal services. You'd have to pay for a solicitor, free valuation, don't have to pay for a valuation, all this kind of stuff. So the cost of a residential remortgage is significantly lower than it is for a purchase. But it's, I think it's a good thing, because as you know, and I know that we sing from the same hymn sheet on this, people should be looking at their finances really frequently and just making sure that they do, they know what they're doing, and refinancing, remortgaging their home is a great sort of way of almost forcing people to do that, isn't it?
Yeah, 100%. It's interesting, really. I mean, if we're going to go back to the question, do you think mortgage rates will fall 2023?
Not by any margin that's worth talking about, really. I think we're pretty much there. It's the thing is, right, so people are saying, oh, well, I'm still seeing some lenders are, I've had 5 emails today from lenders saying we're reducing rates, but I've had 4 emails from lenders saying they're going up. So it's 6 of one, half dozen of the other. Some will go up, some will go down. But that's what it's like in a normal market. What happens is that lenders will go, right, okay, where are we in terms of our targets for the year? How much money have we got to lend? How much is it costing us to lend that money? Yeah. And they constantly reassess. In a normal market, they're doing that. So they're putting rates up. They're putting products. A lot of people don't realize a lot of the time when a mortgage product goes out, it's attached to a single funding line. When that funding line is then gone, they pull that rate and they consider where their position is in the market at that point, and they will reissue new products. So seeing some lenders take reduce rates and some lenders go up, that's normal. That's what just happens in a standard normal market. So when people are, when you see in the media, oh, mortgage rates, but this mortgage lender is bringing its rate down. Oh, that means that mortgage rates are still on, average going down. This doesn't mean that. I think on average, maybe it's come down by, a 0.1, 0.2, in the last month or so. But that to me doesn't show a decrease in mortgage rates, a fall in mortgage rates. It just shows that the market's slightly fluctuating.
Yeah.
A 1% difference, that's a fall in mortgage rates. Do I think by
Yeah.
the end of the year, the average mortgage rate will be 1% less than it is now? No, I don't.
Mm. Yeah. And so if I take that one step further, for first time buyers, what's the advice? Because again, the big question that I keep getting asked is, should I wait? Should I just not do anything? Should I continue to look? I'm saying keep your ear to the ground. What do you think?
Don't ever not do anything. So if you're not buying, save. Um, do you know what, somebody said to me the other day, bearing in mind this was on Saturday night in Brighton after a couple of
After a couple of beers.
after a couple of £7 £25 beers, only a couple of mine because I had one card on me, and and he said, yeah, but it's so hard to save, isn't it? I said, that's just an excuse. I said, everyone can save. Everyone can save. Instead of sitting watching Netflix, do something to make some extra money on the side. If you've got a car, go and drive for Uber. If you, stack shelves at night at Sainsbury's, there are still things that you can do. Start a business where you have more input into how much you earn. Go and find a job where you can be based. You can earn based on your performance. So you can put stupid amount of effort in, work all the hours that God gives, and earn more money. And then reduce your outgoings and make sure that you get to a point where 50% of your income goes into a savings pot. And people look at me like I'm stupid when I say stuff like that. I'm like, if you're complaining that you can't save, but are not willing to do any of those things, then you cannot complain. But if you don't want to save, that is okay. Just don't complain about it.
Yeah. I think one of the big things there is increasing income. Really, like, and having a really big focus on that. Because I think sometimes there's this culture at the minute saying, well, what's a Netflix $9.99 subscription going to do? How is that going to make a difference? Like, it's going to make a difference. Like, it's not just about the Netflix. It's about, right, okay, so what other things do you have? If there are 4 things that you could cancel that equal to 40 quid, that's still 40 quid that you save that isn't going to somebody else's pocket. But I do believe that to a certain extent, there's only so much you can cut. And when you get to that point, hopefully you don't get to that point, the easiest thing to do is probably look at other ways to increase your income. Side hustle, stacking shelves, driving for Uber. If you've got a spare car that's just sat on the drive, actually, you know what? Can you do a rental? Can you hire that thing out? Do you have a parking space that you can rent out? Are there things lying around your house where you're just looking at them thinking, I've not used that thing for ages, sell it, It's really, really important and a big focus right now, because you've got to do everything within your power to make sure that you're not at the mercy of circumstance. Really, it's quite important these days.
Do you know on that, right? So just to even simplify it even more, what I would say to people is, what do you know that someone would pay you to tell them about? And so a live example of this. And during the pandemic, I was, I'd started Grand Junior Finance, and although, we were profitable month on month, it was always in the back of my head, I need some kind of other source of income. And it happened by complete accident. I did a talk at a property event about social media marketing, right? And this guy who was in his late 60s said to me, can you teach me how to do what you've just done that talk about? And I said, yeah, of course I can. No problem at all. I'd never thought about doing this before. And bearing in mind at the time, I think I just started a TikTok account. So it was right when sort of TikTok just became a thing. I probably only had 6,000 or 7,000 followers on Instagram, maybe 1,000 subscribers on my YouTube channel, like nothing major by any stretch of the imagination. The podcast was still relatively new. But I knew more than he did. And he paid me £50 an hour for the better part of 9 months with every single week, right? And then off the back of that, I mentioned on Instagram that I was doing it, and somebody else asked me if I would do it for them too. And I went, yeah. And I thought, maybe I'll charge a bit more. And I charged £100 an hour. And then the guy's, the original guy's wife She was starting a lettings agency. She goes, I need to learn about social media too. Would you do it for the same rate as you're doing it for him? Yeah, no worries at all. So 3 hours a week, and I was earning an extra £200
Nice.
for an extra 3 hours a week, just talking about what I was already doing. I was doing my social media marketing for my business, and I was, just extra money. It's like I said, 3 hours a week. And do you know what that did? That extra £200 a week, what I did, so I'm a big fan of allocating funds to certain things.
Mm-hmm.
So that paid for all my entertainment, so all my Sky, my Netflix, all the stuff you just mentioned. So that was all taken care of. Plus, what else was it? There's some other stuff that was. I think it's my broadband. Covered my broadband. Covered my mobile phone. All those things was. I knew that as long as I was doing just those 3 hours in a week, all of those
They're
bills
covered.
were covered. So that was less money that I then needed to take out of my business as well.
Yeah.
So I was able to stockpile cash within my business. So these are the things that people need to be thinking about. What would somebody pay you to teach them about that And you only need to be 1, 2, 3 steps ahead of them in order to do something like that.
Yeah, and leverage the power of social media. Really, that's the most important thing. Leverage the power of social media, and maybe confidence. Don't wait. I would add to this. Don't wait until you feel 100% confident either, because if you're like me, you're not always going to feel confident 100% in anything that you do, but you build confidence by doing. And I think that's a really important lesson that people should kind of be aware of. Don't procrastinate and wait.
This is the perfect example. Look at this terrible lighting that I've got, and it doesn't matter. It really doesn't matter, does it? Just get on and do it and try it. Do you know what? If you don't try it, you will fail. If you do try it, you only might fail. And so why not? So why not give it a go?
Yeah, 100%. So guys, let me just do a quick shout. I'm really crap at doing this, by the way. There are over 60 people. We've got 19 likes right now, just for the sake of the YouTube algorithm. So how it works is YouTube will look at something and be like, oh, if people didn't like or didn't comment or didn't interact, it was rubbish. The algorithm just kills it. So if we can get that 19 up to 30, 35, that will be amazing. But what else I want to do is you're in the chat section right now. People are talking about the fact that they've seen interest rates go up. Jack is saying here that I think he is saying that his mortgage has gone up by 500 quid a month or something like that. You must be in a variable. If you do have questions, this will be the time to actually put your questions in the chat section.
Well, Jack's just for 5 years. That's what he's saying, from where he was previously to where he is now, and that's I'm seeing that all the time.
Yeah. So if you do have questions, pop them in, and I'll ask Sam. I'll let Sam answer the questions. I might chip in, but this is the opportunity to do that. If not, I will be getting off to go to the cinema, by the way. So
what are you seeing?
I want to go see, what's he called? The new is it Dungeons and Dragons or something like that? It's got Chris Pine or something. It looks really, really cool. But I've already seen John Wick, but I've missed the first 10 minutes of John Wick, and I'm like, it's a long movie. There's a lot of shooting and a lot of stuff going on, but do I want to go and sit through the entire thing for the first 10 minutes?
Oh, wait till it comes out. Sure. Mate, can I tell you, while we're waiting for some questions, let me tell you a cinema story, talk about missing part of a movie. So I'm a massive Marvel geek, big Marvel geek. And when Avengers Infinity War came out, which no,
you don't tell me that you slept through half of the
no, it's even worse. Right? So for anyone that's seen the film, you'll know it's reaching its climax. It's going up through the whole film, and then right at the end, when Thanos comes out and he's killing people, and no one can stop him. And then there's that bit where
Did you miss the hammer? Did you? Oh my god!
Yeah, listen. It gets worse. There's the bit where Captain America's a mere mortal. He's holding back. He's showing all the human endeavor, and the fire alarm went off.
Oh no!
And the lights went up, and everyone had to be vacated out of the cinema.
No.
And I'm like, what? So even worse. They're like, sorry, we got problems. You're gonna have to come back another day. And I have to watch the whole thing again.
The thing, you're never gonna get that moment back, because I love Marvel as well, and that's the crescendo.
Had to go down Travis Norris in the pub opposite. Yeah.
That's not the same. I thought you were going to mention the whole hammer bit, because that.
No, didn't even get there.
Yeah, it didn't even get there. Oh my god, they should have refunded you your tickets for that.
They did.
Oh, that at least you got refunded the ticket, because that just ruins the
your
experience
money
altogether.
means nothing to me. You ruined my life.
Excellent. All right. There are no questions in here, which means I'm going to the cinema. But guys, thank you so much. Sam, how do people find you, by the way? Because I know that you're on Instagram, you've got the podcast, you're also on YouTube. So just share how people can find you.
Yeah. So across all my socials at the Sam Norris, THE Sam Norris with an N for November. So go and find me on Instagram, TikTok, every channel you can find, LinkedIn. On here on YouTube, if you literally just type in my name, because I do this frequently because I'm an egomaniac, I do come up top when you search my name. It's a little blue picture with me smiling, and then I've got the Game of Loans podcast, which Peter, you've been on. So
listen, no, but wait for a minute. How good is that name? Game of Loans. It's like,
and
it's so good.
Here's a cheeky plug, right? That's also going to be the name of my book that's going to come out at some point.
Very nice. Yeah, very nice.
There you go.
Very nice. Game of Loans. Oh, that's just quality. Well, hang on. There's a question here from Felix. Let's just get to Felix. Are you guys saying we should not buy this period? I'm saving now, projecting buy-in around mid 2023. I'm forecasting the interest rates will go down. What do you think?
So it's really, really tricky, because number one, let's just put a little precursor down. Anything we say, just don't take it as fact, because anything can happen. But it depends on the area that you're in. So the market's going up and down in certain areas. If we take what I predict to happen, I think interest rates will be down at some point next year where they are now. And I think the price of property will be down this time next year to where it is now. Therefore, it makes more sense to wait. However, if you find a good deal and you can get a mortgage, just do it,
And that is the point of keeping your ear to the ground. Just make sure that you're paying attention to what's going on. Don't completely just close off yourself to information. Stay on top of what's going on. So if something does happen where actually you can take advantage in a moment, you can do that. There is another question here for Mark. 1 second.
Yeah, this is a hard one.
Okay, look, you can't give direct advice. There's probably a bit more into this that Sam probably needs to know. My 2.1% mortgage ends in November. My circumstances have changed regarding my wife's income, having started at a cafe and now self-employed. Any advice?
So if you're self-employed, lenders will more than likely need to see at least 2 years.
2 years accounts.
Some will take net profit from your business into account, and some will just take salary and dividends into account, and some might take a combination of the two. It's really, really tricky. But if you do not have 2 years worth of accounts, there's a really good chance that your wife's income cannot be taken into account. So what you need to look at is, and I would start looking at this now, speak to either a broker, Chanel, who works for me as our residential broker. She can have a look at this for you, or go and speak to your current lender and get them to do an affordability assessment based on just your income and not your wife's income. If it's down on where it was previously and you have got the 2 years proof, then obviously, again, that's something that you just need to think about. Hopefully, fingers crossed for you, Mark, that your wife's income can be used. The value of your property has potentially gone up, and obviously you've been paying down your mortgage. So potentially the loan to value that you're on will be lower. Therefore, the interest rate compared to where it would be, maybe whatever percentage it was when you first bought it, will be a little bit lower as well. And there'll be a way of moving forward. But there could be a real possibility that you may have to pay down a large portion of some of your mortgage. What I would probably be doing right now, and this actually is advice across the board, not advice in the proper sense of the word. You know what I'm talking about, Peter.
Yep.
Making overpayments on your mortgage is one of the best things you can do. Because it's literally the opposite of the compound effect in terms of just paying down the debt. We were talking about the amortization earlier on. The more you pay down, the more of the balance is being removed, and therefore the quicker you get to the point where you're paying off more of your balance than the interest on a monthly basis. So if you can make overpayments on your mortgage, try and do that as well. And also that gets you used to paying a higher interest rate as and when that is going to happen.
Yeah, really good points there, Mark. Thank you very much. There is one from Jet here. Let's have a look at this one. Bear me 1 sec. I'm clicking on the wrong one there.
I really hope that's their first name, Jet is a wicked name, isn't it? But I've got a feeling
Jet
it might
Life.
be
Jet Life. It sounds
that
like a
that Jet
YouTube
Life.
name.
That
But
Jet
that would
Life.
be that's an amazing life though. That'd be
It
cool.
is. I mean, it is. That sounds great.
I'm looking to get in a fixed rate mortgage for the next 5 years. My current one ended and have seen it go up crazy. Do you think it's reasonable to get one now?
Yeah, look, if you're on a crazy variable rate, the sooner you do it, the better. For every month that you're waiting, and as we've already spoken about on this particular live, there's a good chance the Bank of England base rate is going to go up again at the next Monetary Policy Committee meeting. Therefore, the average price of a 5-year fixed rate might be higher in a month's time than it is now. So you're probably better at just fixing in when you can. It's just unfortunate circumstances that you haven't got another year, maybe to next year when maybe things might be slightly better. But you've just got to go for it now. You've got to fix it. And to be honest with you guys, fixing in for a longer period of time is not necessarily a bad thing. You can budget for that period of time. And you can't always, you can't plan, right, okay, I want to end this fixed rate exactly when it's the lowest interest rate that we're going to hit on the market. You can't plan these kind of things. You just got to do what you need to do. If you're on a stupid standard variable rate at the moment, all you're doing is giving more interest to the bank. You're better off fixing it sooner rather than later, in my opinion.
100%. And I'll just add to that.
Not advice.
Yeah. And I'll just add to that, that again, the function of a fixed rate mortgage is that you're able to budget. It will help you budget and keep your finances in line. And if that's where you need to be, then that's where a fixed rate mortgage will do wonders for you. That's just the reality of how it essentially works. Carly. Love Carly. So she was at my book launch. She's been around here for a very long time. Let me just pop this up quickly on screen. Carly was in a situation where she was in a place where she's seen those interest rate. She's been hit by those interest rate rises every single month since it's been happening. Finally have enough equity and cash to staircase from 50 to 100% or stay where I am. What do you think?
What do you mean by staircase from 50 to 100%? What are we talking about?
I think she's on a shared ownership one.
Okay.
So going up from the 50% to 100% of the property ownership.
I
mean, it really depends on your circumstances, doesn't it? Really, and whether it's going to be right for you.
I'm really not a fan of shared ownership. Massively not a fan. For me, any kind of leg up, even things like Help to Buy and all these shared ownership, shared equity, all these schemes, they are exactly that. They're schemes. As I said before, no one has a divine right to own a property. And don't sell your soul so that you can get on a shared ownership. This is kind of just advice to the wider people listening, I guess. Avoid shared ownership because you're stuck then until you can do what Carly has managed to do. And Carly, if I was in your position, I probably would try and get 100% ownership of that property because it gives you that power back to be able to do what you want with that property. If you're still at 50%, how hard is it to sell a 50% share in a second-hand property? I can't imagine the market for that is particularly big. So yeah, I don't know what your circumstances are. Don't put yourself into a situation where you're financially, strained. But if you feel comfortable with what the cost would be on a monthly basis to get to 100%, then I would probably suggest give it a go.
Yeah, I mean, shared ownership, I think. Probably from a location point of view, if you look at it, and I don't know the data, it probably has been very beneficial in London where property prices are just nuts.
Yeah.
And it probably serves a purpose there. But, owning 100% of property is always a nice place to be, in opposed to half if you can. So if you can take that opportunity, and I know a number of people have been able to take the opportunity as well. So it's been good. All right, cool. Sam, thank you so much for this. Really do appreciate it. So let me just say a couple of things before we go. One of the things that I'm thinking of doing now that the podcast is going onto the channel every Monday at 12 o'clock, I recently discovered that I have the ability to take calls on the podcast. So I'm toying around with that idea. But you're probably thinking the same thing I'm thinking, Sam. Red lights, red flags going off all over the place. Regulation. So that's the one thing that I'm a bit like, okay, we need to be a little bit careful. But it's something that I would love to do because I think we're having this conversation here and being able to have conversations with people just generally who might be a little unsure about their circumstances, just to have a conversation to open up and get people thinking about things is something that I would really, really, really love to do. And I found out that I can actually do that. So what I will do in the next maybe day or so is post a poll in the community and across social media and stuff like that. If you're watching on Instagram right now, I'd love to get to know your thoughts. In the way it would work is it would actually be a phone line, not on screen. But that's what I want to do. But anyway, we'll see. The other thing I want to mention is on the podcast as well, which is an extension of that. There is a place on my website right now. So the Conversation of Money website is diverted to peterkomalafe.com. If you go onto that and you go onto the podcast, you can also submit your questions to the podcast. And what I'll be doing is, the plan is that once a month, I'll have an episode which will be dedicated specifically to your questions. So make sure you're using those facilities. But I appreciate every single one of you for being here this evening on a Thursday. And thank you, Sam, for coming along as well. I hope you found something to take away. We can't give you a definitive answer as to what's going to happen with mortgage rates. We can best guess this based on the data, based on the information that is out there. But hopefully you found it useful. And thanks again, Sam, for coming along. We'll catch you.
Enjoy your
later.
film.
Oh, cheers, mate. And yeah, if you're not following Sam, you should go follow Sam right now. All right. Cheers, guys. Thank you very much. Have a good evening. Cheers, Sam.